Dan Jansen,
Here.
Christine Hoffman, Brandon Maresma, Eddie Vergara, David Cohill,
Here.
John Patrick,
Here.
Matthew Grocky, John Godstella,
Here.
Jason Sharp, George Candler, John Wiggins, John McDaniel,
Here.
Lance Hewish,
Let the record note that Mr. Candler has joined us, and we have a quorum on all three of our boards. Did we already do the oath of office? Is it oaths of office or oath of offices? Yeah, think on that. 2 a.m. Okay, so we're done with that. Moving on to approval of minutes. We have the quarterly pension board meeting minutes held on September 9th. Sorry, so we have a motion for approval. Is there a second?
Second.
All in favor signify by saying aye.
Aye.
Any opposed? I just did that as a whole board. Is that okay? We good? All right. Moving on to new business, consultants reports. Do you want to take this over? Who's taking over?
I will jump in real
Okay.
quick. So really first on the agenda, we have the real estate presentations. So in the stack of books from me, the one on the top is the core, it says core real estate search. Really, I'm just pointing this out kind of as a reference. So as the presenters are going, if you want to, by chance, look and see how the different strategies stack up kind of next to each other, whether it be office holdings or retail exposure or what have you, we've got that comparison information here. But obviously, they're going to be walking you through their presentation book. But then after the conclusion of those 3 presentations, we'll kind of circle back and go back over this to discuss. But with that, do you have any questions before we turn it over to Principal for the first of the presentations? Hearing none? All right, gentlemen, please.
Thank you. Thank you all. Thank you for having us here. My name is Greg Pittenger. I'm a client advisor with Principal Asset Management based in Raleigh, North Carolina, and work with institutional investors like yourselves all throughout the Southeast. Have worked with Florida pension investors in the public space for the last 15 years. So thank you for having us here today. My colleague, Darren Kleiss, is our portfolio manager for the U.S. property account, which is our core real estate vehicle we'll be discussing today. You should all have a presentation from us. It's kind of the dark blue, the first page here. It's dark blue for Principal Asset Management. I'll give you a brief overview of Principal Asset Management and the real estate platform, and then we'll dive into the strategy. But on page 4 of our presentation, you'll see we're a top 10 global real estate manager, managing a little over $105 billion in real estate assets at the end of last quarter. One thing, a deep heritage of working with public pension plans like yourselves for the last 60 years. One differentiator there I'll point out on our right side, we call it our 4 quadrants, and today we're going to be talking about that royal blue top left quadrant, which is our core and value add private equity real estate area. It's the lion's share of our assets at $55 billion of the $105 billion. So as Darren's team needs access to any resources within the firm, he gets it. Obviously, that's where the focus of the one of our crown jewels in our real estate practice is. But the differentiator really is that we all have private equity real estate as well as public real estate, so REITs, as well as on the debt side, private real estate debt and public real estate debt. And what that does is for you all as clients, brings the deep resources of our rest of our team to Darren to figure out what's happening in each of the spaces, in each geography, what actually is happening both on the debt side and the equity side of opportunity. So it gives Darren's team some deep insight on your behalf to make transactions happen, whether we're looking to buy an asset or to sell an asset. If there's any questions on the real estate franchise, I'm happy to answer them. Otherwise, we can go right into the portfolio. Thank you.
Great. Thanks, Greg. I'm Darren Kleiss. I've been with Principal since 1992. I've been working on the assets of this fund or the fund itself since 1994. So got a long history with the firm and with the portfolio and the assets. And so Principal is a very good place to do what we do. We're a large retirement services company, and a big part of that is our real estate operation. And we're very much strong believers that real estate's got a very big place in retirement plans. So, excuse me. Some real high level stats on the fund on slide 8 there. We're about $11 billion fund. We've got 125 properties. Our leverage ratio there is about 26%. That's simply the amount of debt divided into our total assets. So we're relatively low leverage. A lot of real estate strategies operate with a lot more debt, and so debt is great when it magnifies returns when things are going great, and it magnifies things when the negative returns when it's not doing so well. So we're a relatively low leverage strategy. Our 36 million square feet is about 92% occupied. And then we've got a strong 1-year net absorption. That's simply a measure of the square footage or the space that's leased today that was not leased a year ago. So we've got good momentum in leasing space within the portfolio, and that'll soon start paying rent if it hasn't already. We've got 129 institutional investors such as yourselves, and that's everyone from the state of Florida. The State Board of Administration is one of our larger investors in this fund, down to smaller plans like Jacksonville, City of Jacksonville, Jacksonville Police and Fire, and Gainesville, as well as smaller investors like Pompano Beach. And so, sure.
Is there a location where we could see all your listed investors?
We don't publish a list of our investors, but I'm just mentioning the ones that are public and are publicly, if you wanted to search these plans, you would see them in public records. So we don't publish a client list or anything like that. So.
Okay, thank you.
A couple of things on investor flows there. We do not have a contribution queue. In other words, we're taking contributions on a daily basis. We strike a daily net asset value for this fund, and so if investor sends us money today, it goes into the account and is invested today. And if an investor gets money out, today as well, they get out with all the information that we know about the value of the property as we strike a daily, what we call NAV or net asset value for the fund each day. So you don't have to get in and out on quarter end or anything like that, because we do price this, and Principal is one of the largest 401k providers. This is available to defined contribution 401k investors, and we strike a daily NAV for that investor. So all of our investors get the benefit of that daily pricing. And so, there's no magic to coming in at the quarter end or at the beginning of the quarter or anything like that. And so we just announced on last Friday, we just what we call cleared our queue. So the investors wanting to get money out of the fund, we, in addition to all other real estate funds, have a withdrawal queue. And we've cleared ours now twice. We cleared it last Friday, and we cleared it in February of this year as well. So investors that wanted money out could get their money out. So in the 43-year existence of this fund, we've had a withdrawal queue in place 3 times. Other than that, we have daily liquidity for this fund. So until there's a little more certainty around the economy and the real estate markets, we're going to keep that queue in place. But our goal is to go back to that daily liquidity. So if you want money out tomorrow, you'd be able to get money out tomorrow. I mean, that's for 90% of the fund's existence. That's the kind of liquidity we've had in this fund, and so we're looking to get back to that. But there's still a lot of funds that do have withdrawal queues, and what we don't want to do is become a source of liquidity for those investors that have investments in multiple real estate funds. And so until there's a little more liquidity in the industry in general, we'll probably have that withdrawal queue in place.
So, real quick, sorry. 43 years, you've had it 3 times, you've had it twice this year. Is that correct?
Well, we consider this once. And so we had it once during the global financial crisis in 2008. We had one during COVID, and then we put one in place in July of 22 when interest rates went up, really fast, really quickly, and the market had not repriced. We put a queue in place, and so that queue is still in place.
Okay, thank you.
Even though we've cleared it, we provided liquidity for all those investors that wanted it.
Okay, thank you.
Slide 9 is just sure. Is there another question? Okay.
Yeah, I had a question.
Sure.
What does that queue look like? Is it 2% a month or?
It's probably about on average, $4 to $5 million a week, and a lot of that is those defined contribution participants that look to rebalance and automatic with rebalancing or something like that. And so it's probably on average $4 to $5 million a week. Initially, it was a lot of large investors that had strict asset allocation guidelines, and when they were found themselves overweight to real estate, and so they rebalanced. So initially it was a lot of institutional investors, and now it's more defined contribution participant directed money that's primarily in that queue.
Yeah, I wasn't asking who was in the queue. I was asking how you guys restrict the flows. Like, do you guys cap a percentage of NAV flowing out every month? Or, 1% of the fund, 2% of the fund?
All withdrawals are queued, with the exception of mandatory death, disability, and benefits. Other than that, everybody is queued. Everyone's treated the same.
Yes. What percentage of the fund do you allow out during this queue? You said you cleared it, so obviously there's got to be a cap that you allow over a certain period of time.
We satisfied 100% of the investors that wanted money out. I don't know. Does that answer your question?
No.
Okay.
It's, the queue is there to slow the money down coming out, so everybody doesn't hit the door at the same time.
It's to stop it. It stops all the money. Yeah.
But you still are letting some money out.
Let me jump in. When the queue's in place, they get to give no money until they're ready to give some money. Some could be all, right? So if the queue's in place and you ask for money, there's no guarantee you're getting anything for a number of months, potentially quarters, as long as that queue's in place. But it just so happens that as that queue has built up over the past couple of years, it was at a level where they could go ahead and make the decision, okay, we've got the liquidity, and I'm just going to make this number up, but it was $200 million that happened to be sitting there in the queue. They looked at their profile and said, we can access the 200 and completely pay off everybody that wants their money. Now, had it been 200 and they looked and they only had 100, then they would have given everybody 50 cents on the dollar that they had asked for. And then that other 100 would just stay there in the queue.
I understand. So the queue basically is zero. Like, we don't have to let anything out. We'll let it out as we want.
And it can be a bit chunky. It's not, you're asking 1% or 2%. It could be like we paid out $200 million one time. So it's not a portion of that. It's when we also sell a building and have some liquidity available.
Got it. Okay. I get it.
And just to put that into perspective too, we are in a fund with JP Morgan in the redemption queue. They've been averaging paying you about 5% on a quarterly basis. Now that could all of a sudden jump to 30, 40, 50% of the outstanding balance at any point, but they're in control of that.
Is everybody getting a part of that queue? So
Yeah, it's pro rata.
So not one person in the front gets it.
Correct. And it's not just like the first person in line gets their dollar back before anybody else. It's all of the dollars that are in the queue. And then again, my example, if 200 is in the queue and they've got 100 that they can pay, then everybody gets 50 cents on the dollar for what they have requested.
Yeah, that's right. So we just made a little over $200 million available, and actually, I got an email before I came in here. Our largest investor declined to take their queue payment, so they want to stay invested in the fund. So the reasons that they got in the queue are no longer valid today. They thought they could avoid some write-downs that were coming in real estate, or they were over-allocated to real estate. But now that the other asset classes have done well, they're like, well, the reasons we got in the queue aren't valid anymore. So I just want to keep my money in there, and I want to get out of the queue. So that's becoming more common too, as the market, as NAVs have adjusted to the current prices. So page 9 is just a couple things that have resonated with our current investors that have chosen to invest with us. Long-term outperformance, that's at the top of the list, and so we're outperforming our benchmark, or essentially the market for real estate funds like ours over all time periods. We're very good option for a lot of pension fund investors. We're a retirement services company. We're very used to managing pension money and clearly value and view this investment in the context of an overall investment portfolio. Growing NOI, which is net operating income. A couple ways we make money in real estate. One is the rents we collect, the income we collect, but also the appreciation. So it's a pretty simple business. We just try to buy good buildings in this. I know you guys look at a lot of asset classes that are a lot more complex and a lot of financial engineering. Ours is a pretty simple business. We just try to buy good buildings we can lease out and that are going to be worth more in a few years than they are today, than we can buy them for today. We've got a very strong research group that we generate a lot of research with that's available to all of our clients and as well as us. We're really good at just working the operations of the property as well. That's demonstrated by that strong leasing number that I got there that I mentioned earlier. And then also our average cost of debt capital. We've got a slide on that a little bit later. Turning to slide 10, just some things that we think about as strategy of the fund. We've got, as you can see, the vast majority of the properties in the fund are stabilized, well-leased assets, but we do have a couple other opportunities to add to the portfolio in terms of taking some intentional leasing risk and ground-up development risk. We have two assets in that development bucket right now. One is some apartments in Los Angeles on Sunset Boulevard, and the second one is an industrial development in Austin, Texas, just north of the new Tesla Gigafactory in Austin. And so we just signed a 270,000 square foot lease with Tesla in the second quarter for a building that wasn't even completed with construction yet. And we're actually in final negotiations with them to take a couple other buildings there as well. So very good, very well located property that's attracting a lot of brand name tenants. Slide 11 is just pretty self-explanatory where we've got the portfolio position from a market perspective. We do have a couple assets here in Jacksonville. We've got some industrial out on Pritchard Road, just off 295 on the west side of Jacksonville. We got a building leased to CarParts.com and a building leased to Home Depot and Pods, as well as some industrial buildings up by the airport, just south of west of 95 and just south of Airport Boulevard. So we are invested here in Jacksonville, not in Jacksonville Beach, but we are in Jacksonville and like the market and have done well here. We've got a page devoted to each of the main property types that we're invested in. There's four main property types that have kind of comprised core portfolio investments. The ones we like the best are industrial, and we've got overweight positions to industrial and residential. And you might think of residential as just rental housing, and all different kinds of rental housing, whether it be student housing at Duke University, down to manufactured housing or affordable workforce housing, as well as some really high quality renter by choice that really caters to that segment of the population that can afford to buy a home but chooses to rent for whatever reason. So
anything in the short-term vacation rental?
No, we have nothing in that space. We used to have a few tenants that would lease an apartment from us and then do that on their own, but we've essentially restricted that within our portfolio.
Good. Thank you.
Slide 14, and we're a diversified fund. We've got a little bit in everything. Office is the property type that's been in the news and certainly been the worst performing property type over the past couple of years since COVID, the onset of COVID. We've actually been bringing office in this portfolio down. Back in 2015, we were 47% of the portfolio was invested in office, and we brought that down to a meaningful underweight today, and most of that office was sold pre-COVID. So we sold over $3 billion pre-COVID out of our office portfolio. And the office that we have left is very high quality, leased to good tenants, and that's really benefiting from what's happening now as a real flight. And there's still issues within the office market in general, whether it be work from home or reductions in corporate payrolls. But the office we have is actually performing pretty well right now. It's been written down. Office in our portfolio is written down about 48% from peak values. Since if you call December of 2019 peak values for office, we're down about 48%. So the office write-downs have been taken, and actually office is performing. The high quality office is actually performing pretty well. We're doing new leases. The property picture there, it says Anaheim, but it's really Irvine, California, and Orange County. We've got a large property there that's leased to Western Digital and Panasonic, our largest tenants, and we're actually negotiating with a large national or really global food company right now to occupy some remaining vacancy in that spot. So it's really emblematic of what's happening in the office space. Is just the quality buildings are getting the leases and catching the the eye of investors as well. We don't have any investments in some of the hardest hit markets like San Francisco or New York. We've sold out of all those markets, and we're really in those growth markets. Our largest office buildings in Austin, Texas, we have a building leased to Google. We have the best building downtown Austin, Texas, and 70% of it's leased to Google. And we have Deloitte and CBRE and a number of other tenants there. But well leased, well occupied, and we're really getting some of the highest rents that we've ever gotten in those buildings. We've got another building in Washington, D.C., where Amazon's our largest tenant. We're about a block from the U.S. Capitol, and Amazon does all of their lobbying of the federal government out of our building. And so very strong, again, we're signing the highest lease rents we've ever owned or ever signed since we've owned that building. So very strong demand for those high quality office buildings. Office is kind of been in the barrel the past couple of years. The retail, probably 10 years ago, retail was kind of in the same spot office is in. Retail is actually doing very well right now. We're actually closing on a new retail center the first week of December. And so retails, we're seeing good growth in rental rates as well as strong tenant demand. The kind of retail we own in this portfolio and have always owned is really necessity-based or grocery-anchored retail. We don't have any malls. You can see about a third of the benchmark, 32%, is still invested in malls. And so we've never owned a mall, and we're never going to own a mall, but we'll continue to add the kind of retail that we like and have been very successful with those grocery-anchored centers. And some of the most interesting opportunities are coming from outside of those four core property types. We've got an allocation to data centers. It's been the best performing part of our portfolio the past couple of years. We've got a 4% allocation to data centers. Very strong tenant demand. We just signed in the third quarter, we just signed a lease with a data center user. We've got a property pictured there is in Plano, Texas, in Dallas. Leased a company called CoreWeave that's been in the financial news. They went public in the second quarter. So very, very strong tenant demand there within that part of the portfolio.
Any data centers in Northeast Florida?
Not in Northeast Florida. We have a data center in Sunrise in West Broward County. So that'd be the closest data center that we have here. It's at least one of the large cell phone companies. That's kind of their operational center out in West Broward.
Thank you.
We've got probably the thing our team is most excited about is our NOI growth on slide 18 and 19. We just detailed that. We've been able to grow our income at a rate of about twice the benchmark. So we've grown our income almost 6% in this portfolio over the last 10 years annually. You can see we had a setback in 24. Actually, we took a year of free rent from one of our largest tenants in exchange for 8 years of additional lease term in our office portfolio. By doing that, we were only able to do that because we've got a strong balance sheet and we could go without that income. But we were able to get some lease term that made that building financeable and saleable. And so we actually sold that building in the second quarter. We went for a year of free rent in 24, and we sold that building in the second quarter of 25 this year. So that was a very intense. Our NOI growth would be a lot better if we wouldn't have taken that, given that tenant free rent, but that was an important, good long-term deal that we're able to do because we've got a strong balance sheet for the portfolio. So, but we've got some very good opportunities to grow our income going forward. Slide 20 highlights our debt within the portfolio. We don't have a lot of debt, but as I mentioned, we're a low leverage real estate strategy, and our average cost of debt is 4.08. Obviously, well below what you can get for borrowing today. It's about 50 basis points lower, or 0.5% lower than the benchmark. And so it might not sound like a lot, but on $2.5 billion worth of debt, it's significant, and we think it's a competitive advantage going forward as well. Performance, pretty self-explanatory there, but we're exceeding the benchmark over all time periods for total return and income return. And then on slide 22, we show another data center property. And then on slide 24, we just have a summary of account terms. We've got, as I mentioned, daily liquidity on this. This fund's been in existence on open-end basis since 1992. We've got, a number of other investors such as yourselves in the fund. Our minimum investment's $1 million, and we can take that. You can again, call us tomorrow and say you want money out, or you can call us and say, hey, we want to put money in tomorrow. By striking that daily net asset value, we're able to accommodate. That's a feature that a lot of our investors really value.
Yeah, part of that flexibility I want to mention is you all are getting out of another fund that Brendan mentioned with JP Morgan. We have the flexibility to accept some capital now, and as that comes in, as you get 5% a quarter or whatever it may be, we can accept that capital as it comes. So that's part of the flexibility we think is a benefit.
I know we're about out of time here, so I'll probably look to wrap it up. But we're very excited the way the fund is positioned today. We went for a couple of years without calling capital in this fund until the net asset value had adjusted down to the current market pricing. And so at this point, we're very optimistic about where the fund's going and how it's positioned today. We've got our overweights to the right sectors. We've got a strong balance sheet. We've got a consistent team in place, as well as we think it's a great opportunity to buy into a high quality portfolio that's been repositioned and repriced for the current market environment. We've got a lot more information in here, our 10 largest properties, pictures and maps, as well as a bunch of other stats of including every property in the fund. So we're very transparent about fund operations and about what we're invested in here. So,
Can I ask a question?
sure.
We can go back to number 16 on data centers. If you're watching the stock market the last few days, all these guys, NVIDIA, Microsoft, they're all trying to out-billion-dollar each other. And now the market's concerned about how you're going to pay for that. I know several of them have a lot of money, but they're going to create a lot of debt. And is it going to be, what's going to happen there? The data centers are building them on every corner like Starbucks now. So what's going to happen there?
We're still, we've read the headlines about the stock market as well. I mean, we continue to see strong demand from the users at the data center. And if anything, there's pent up demand that probably hasn't been able to be met just based on the constraints of power and a lot of the components that go into these data centers, whether it be, chillers or cooling equipment or backup power. All that kind of stuff. There's been huge backlogs with all that equipment that goes into the data center, including just limits on power. So we would expect a lot of the froth to come around off some of those fringe areas as well. Well, there's I think a bunch of money being raised around that. So this property we've got here in Plano, we actually are looking to expand the power. We talked about this in the meeting earlier, but we've identified 14 megawatts that the power company in Dallas, Encore, can provide our facility. We have all the power we need that we're contractually obligated to provide. But our partner has identified 14 megawatts that the utility Encore could provide us. It's capacity they have in the neighborhood that's served by the substation that's not being used by any other users. So they're looking to redirect that to our property. So we have a lot of expertise in this space to kind of get a lot of that power redirected to us, and we can either lease that to our current tenant, or we can lease out to another tenant, bring another tenant to the building. But power is a real constraint. It's not only power, but it's the backup power and the cooling power and the switchgear. Switchgear has been back ordered for years, and so it's not just power; it's all the equipment that goes along with it. And so, but you're right, there are big shortages there. Yeah, I live in Des Moines, Iowa, and actually Google just bought the only nuclear power plant in Iowa. It's been, I think, offline, but Google just swooped in and bought a nuclear power plant in the middle of nowhere in Iowa that nobody knew existed. So it's happening, yeah.
Any other questions? Well, thank you all for the time, and if we're fortunate enough to earn your business, we appreciate the opportunity here today. Thank you.
Yeah, thanks.
All right. Well, good afternoon, everybody. Mr. Chairman, members of the board. Very nice to be here. Thank you for inviting us down to present Smart Markets Fund to you today. My name is Cormac Dotty. I am a senior vice president in our client relations team at Stockbridge. I'm joined by Chris Owens, who's a vice president and associate portfolio manager on the portfolio team. So thrilled to be here. Over the next 20 minutes or so, Chris is going to talk you through some of the key features and benefits of the Smart Markets Fund. It is one of the top performing funds in the NCREIF Odyssey Index. One of the benefits that you'll hear from Chris talk about is the fund's income returns. It does have the highest income return in the index over the trailing 10 years and historically has been able to outperform the index's income returns since inception of the fund in 2011. So you'll hear about that, lots more. But first, I'd love to talk to you a little bit about our company. So if you'd like to open up on page 8 of the presentation. Stockbridge was founded 23 years ago by Terry Fancher. He's still our CEO today. When Terry started the company back in, all those years ago, we had a handful of clients and about 800 million under management. And today, fast forward 23 years, we have over 150 institutional investors invested in our platform. And we're really thrilled to have gained the trust of so many of those clients over the years that have continued to invest with us. And on behalf of those clients, we manage $36.5 billion of real estate across the U.S. today. So that's really only possible with the trust of our clients. 45% of those are public pension plans, just like Jacksonville Beach retirement system. And in Smart Markets Fund, 68% of our clients are public pension plans. So, we take our role as a fiduciary very seriously, and we aim to strive to really be good stewards of your capital. So just looking across an overview of Stockbridge, 200 employees spread pretty evenly across the U.S. in our 6 offices. We invest in pretty much every major metro across the U.S. We take a very boots on the ground approach to investing. Real estate is a very local game, and so we have experts in our offices that cover markets and have a very local presence. We are a diversified manager, so we invest in the 4 main property types: residential, industrial, office, and retail. Within those sectors, we have subsector specializations, and you'll hear more about those as we work through the presentation today. And lastly, we invest across the risk spectrum, so from core plus, value add, and opportunistic. In the interest of time, I'll skip over page 9, but you'll see a history of our firm's growth. Smart Markets Fund has really been integral to the success and growth of the firm, launched in 2011. Lastly, I would just invite you to turn to page 12, and I'll just briefly touch on the fund's investment committee. So the fund is governed by a very seasoned investment committee made up of 12 members. That includes the fund's portfolio manager, Mac Johnson, and Tuba Malinowski, who was actually the founder of Smart Markets Fund. Tuba launched the fund in 2011, and she's still on the investment committee today. I would just say, very seasoned team of folks overseeing the Smart Markets Fund in the investment committee. No senior level turnover on the IC in the last 5 years. Dan Weaver at the bottom right, he heads up our Chicago acquisitions team. After a 40-year career, he's preparing to retire at the end of this year, and we've introduced Brian Bill and Tom Grusecki onto the investment committee. But otherwise, very stable and experienced team on the IC. So I'll pause there in case of any questions on the firm. If not, we'll jump straight into the fund. On page 13, introducing the fund's team. As I said, Mac Johnson is the portfolio manager. Mac has been with the firm for 11 years, working on the fund all of that time, dedicated to the Smart Markets Fund. The growth and the success of the fund is really a large part in part to Mac's role in growing the fund. Working very closely alongside Mac is Chris Owens, who's been working on the fund for 8 years now. Chris specializes in transactions and oversees our valuation process. Also working alongside Mac and Chris, we have Megan Finneran, recently joined the team as head of portfolio operations, and Megan brings a deep expertise in asset management and specializes in multifamily asset management as well. So great to have Megan as part of the team. And then we have an associate and an analyst. So, I would just say very stable and experienced folks running the Smart Markets Fund that have been working together for quite a long time. The fund also benefits from a deep bench of transactions and asset management professionals working at the firm, 21 investment professionals sourcing deals for the Smart Markets Fund, 31 investment professionals working on the asset management side, executing on the fund's business plans. So with that, Chris, anything that you would add on the team?
No, that was great, Cormac. Thanks. I would just add that, with Mac, with over 10 years of experience, I've worked with Mac for my 8 years at Stockbridge, with Tuba still being on our investment committee. I think that continuity across our team has really benefited us. We'll talk about the original strategy the fund had at its inception. By keeping, that team intact, I think we've been able to continue to carry out that strategy. Sometimes when you get a new PM team to come in with certain funds, they want to change things up. It can be detrimental. I think we've had the benefit of that continuity over the years, which has been part of the reason for our outperformance. But with that, we'll get into the fund story, and we'll move on to 14. And I'll try to get through this relatively quickly in the interest of time. So the Smart Markets Fund, it was launched in late 2011. We sit at just under $5 billion in gross asset value today. We are nearly 93% occupied. You'll hear me talk quite a bit about how important occupancy, cash flow, the income return outperformance is for our fund. We have a relatively limited non-core exposure at 5% today. So we want to own assets that are, well occupied, the cash flow and return, income through a distribution to our clients. Where does the name Smart Markets come from? The original kind of market selection strategy for the fund was that we would target markets that had a higher percentage of bachelor and graduate degrees, and that for a market that has a more educated workforce, that would ultimately drive jobs to come to those markets, and then jobs in particular in industries like technology, healthcare, finance, energy, etc. And that, with job growth in those certain sectors that do pay well, there would be a high correlation to real estate outperformance within those markets. So that was the original strategy. That's where the name comes from. That's still a major part of our market selection today. Moving on to 15, the fund's competitive advantage relative to some of our peers in the index. We'll talk quite a bit about our liquidity position today. The fund does not have a redemption queue. We have not had one since January of this year, when we paid it off in full. We've had quite a bit of success raising capital over the last 12 months or so, over $700 million in commitments. And our commitment queue as of 9/30 was $241 million. We are expecting a sizable capital call in January that will get us down to around $113 million in dry powder. But that's given us the ability to not only return capital to our clients when they've asked for it through redemption requests, which we feel like is our obligation when we're able to do so, but it's also given us ample dry powder to take advantage of buying opportunities and what's been a pretty attractive acquisition market over the last year or so. Cormac hit on the gross income story. Again, the top performing income return across Odyssey over the last 10 years. Our income return over the trailing 1 year was nearly 5%, which is 86 basis points higher than the index. And then briefly hitting on our property type and market exposures. We're a low office fund, have always been a low office fund from the fund's inception. That's 5% of our fund today. And you'll hear us talk about having an overweight to the Southeast in particular. I sit in Atlanta. Most of our fund team sits in Atlanta, and we have good relationships throughout the Southeast, Nashville, the Carolinas, Atlanta, Florida as well. So that's always been a point of emphasis for the fund, has been a benefit from a return perspective as well in recent years. Moving on to 16, we have a chart here that shows the fund's redemption redemptions as a percentage of our net asset value, dating back to 2022. So that's the green line. The blue line is the Odyssey weighted average across the entire index. And so you'll see that, as I said earlier, since January, we have not had a redemption queue. Odyssey, as of June 30, sits at 14% of net asset value. So again, we were able to raise some capital to help pay that down. We also made the effort to sell investments to return that capital to our clients. But ultimately, that's freed up our ability for the capital that we have raised as of late to go take advantage of an acquisition market that's pretty attractive. In terms of fund performance on page 17, really good outperformance across all time periods. We are a top 3 fund within Odyssey across the 1, 3, 5, and 10-year period. 187 basis points over the 1 year, roughly 300 basis points over the 3 and 5, and over 200 basis points on the 10 years. So really good outperformance over all those time periods. I'll talk on the next slide about the income story. That's been a big part of that outperformance. So moving on to 18, this shows the fund's gross income return on a quarterly basis dating back to 2022. So the blue line is Smart Markets Fund's gross income return. The green line is the Odyssey value weight average for the income return. We've actually outperformed in every single quarter. That's 55 quarters since the fund was launched in 2011 when it comes to our gross income return. So that's a big point of emphasis for our fund team and how we manage the fund. What we buy, what we sell, what we finance when we make leasing decisions is trying to emphasize that income return outperformance. In the interest rate environment that we're in today, we expect interest rates to stay relatively steady, maybe a couple of rate cuts coming up in the relatively near future, but we don't expect to return to a near zero interest rate environment like we were in coming out of the pandemic. Income is likely to be the major driver of return performance over the long term. If you look at commercial real estate performance dating back to the late 70s, early 80s, over 70% of total real estate returns come from income. So we feel like having this income return outperformance really gives us a leg up relative to our competition, where we're not so reliant on appreciation to drive those returns.
So since inception in 2011, I see from 22 to 25 in this chart. Can you just give us just a super brief overview of what 2011 to 2022 looked like?
It's similar. So on an average, dating back to the fund's inception, we have 23 basis points of outperformance each quarter. So that's the average spread. It would just look very messy if I showed all the way back to 2011 on this slide. So we showed the more recent window, but actually, larger outperformance, kind of more in the ballpark of where we've been over the last year or so, where you see kind of 25 basis points in 2 quarters ago, 27 basis points a few quarters ago. It averages 23 over the long term.
Okay, thank you.
And again, 496 is the trailing year gross income return, which we feel like is a meaningful spread at 86 basis points and near 5% a gross income return relative to kind of where the Treasury sits today. Feels pretty good. So moving on to page 20, the smart markets. I talked a little bit about kind of the market selection strategy. These are the 19 target markets, the smart markets. They've largely been the same since the funds launched in 2011. We've added a couple markets, but again, they've largely been the same. Charleston and Phoenix in particular were 2 additions in recent years. In terms of where we're overweight relative to the Odyssey Index, you'll notice the Southeast, all these green dots are where we're overweight to the index. Again, with our team being based in Atlanta, having relationships throughout the Southeast, we were early adopters of investing in markets like Raleigh, Charlotte, and Nashville, etc. And certainly coming out of the pandemic with folks relocating for jobs or for quality of life down to the Southeast, that's been a big benefit to us. We also have a meaningful exposure to the West Coast. Our headquarters is in San Francisco. We have very good relationships in the Bay Area and Los Angeles in particular. So we continue to lean into those markets as well. Where do we look different in the Odyssey Index? We don't own a lot in the Northeast or the Midwest. New York would probably be the largest outlier, where we only have one multifamily investment. And you'll notice in some of the larger Odyssey funds, they have very meaningful exposures to New York. So that's been a benefit to us from a return perspective. On 21, the diversification by property type. I'll kind of talk about where we are relative to the index and also relative to our internal targets. The fund has been overweight to the industrial sector really since the early days of the fund. And so that's been a benefit to us. Is if you looked at where Odyssey has gone from 5 years ago to today, that number was kind of high teens industrial exposure, low 20s. To get all the way to 34%, there's been quite a bit of buying activity. throughout across many of our peers in the industrial sector at a time when industrial was very expensive. We've had that overweight, and we've actually been net sellers of industrial over the last 5 years or so into a pretty overheated market. So we've been able to maintain that overweight really mostly through how well it's performed through appreciation of our existing assets. But we're very comfortable at 40% today. I feel like that's a good position to be in. We'll likely maintain that overweight going forward. Residential, we have a slight underweight today. I think that's our main target on a go-forward basis in terms of buying. We feel like there's a shortage of housing in this country, and long-term there's going to be a demand for investment in that space. We're particularly interested in the affordable space and the affordable housing space. So that is what we're utilizing a lot of our dry powder that we have today. The equity we have available today is in the residential space, and would hope to be more in line with Odyssey in a year or two. Retail, we have the largest retail exposure within Odyssey. But what we own in the retail sector is almost all grocery anchored retail. We do not own any malls. And so that has really performed quite well for us. We've always had a retail overweight, but we have leaned into that story quite a bit over the last couple of years. And the retail sector has been the best performing property type within Odyssey over the last couple of years. So the grocery anchored products, that would be Publix anchored centers, Harris Teeters, Whole Foods, Trader Joe's, etc. Almost all throughout the Southeast. We have a Publix anchored center here closer to downtown in Jacksonville. And there's been very little new construction. It's very difficult to build retail today. Our tenants have pretty limited options in terms of where they can go. So the retention rates stay high. We're able to move those rents. And it's been a very good story from an income perspective. So that's a story that we've leaned into, and retail has really benefited us. But again, no mall exposure, which differs a little bit from some of our peers in the index. We're a low office fund, 5% today. It's on the low end of our target range. I don't really see us moving that number materially, though, in the near term.
Have you dabbled in data centers or energy?
We have not. We're evaluating the spaces, but I feel like Mac Johnson, who runs the fund, actually previously worked in the data center space. I think he feels like it's a better development strategy than it is a core buying strategy. And with the amount of equity required, it would require such a large percentage from a diversification perspective to get into the data center space. We just don't really feel like that makes sense.
Thank you.
For our fund.
Under your residential, are you seeing more rental? It's harder to get loans. People are 40 years old now when they're buying a house instead of 22.
Yeah, there's certainly, there's been an increase in the percentage of renters in this country, which is, I think, part of the reason why we like that space. There's been, a good amount of supply in recent new construction, and in recent years, although that's dropped off. But yes, our retention levels within for example, our apartment buildings that we own has been very high because we're not seeing the sort of move outs to buy homes that we used to see, which is part of the reason why we like kind of increasing that allocation going forward. You'll have to see interest rates drop materially or home prices drop materially, and neither of those are happening. So it could happen, but interest rates are probably more likely, I think, it's possible. I don't foresee it in the near future. And then our other exposure is one life science campus that's in the Bay Area. That's leased to a company called Exelixis. That's a drug discovery company. They focus on kidney cancer treatment. It's a public company, good investment grade credit, long lease term, so very safe investment. But that's our one kind of other investment. Briefly on 22, kind of the point here is to illustrate, I talked about being overweight to industrial from the beginning. This only dates back to 2018, but the story would hold true if we went all the way back to 2012. The dark blue bar is industrial. Again, we've been over 30% dating back to that point in time. I would also highlight with the light green bar with office, we made the decision to sell out of some office kind of really before the bottom fell out of the office market. The pandemic obviously had quite a negative impact on the office market. We were able to exit some of those investments. So we saw maybe some risk coming with the individual assets. And so that's been to our benefit as well. The other thing that I would highlight is, we raised quite a bit of capital coming out of the pandemic. We were able to do some off-market investments, whether that's our life science investment I just spoke to, which is number 4, a grocery-anchored recap, which is number 6. Buy those off-market, buy those at higher cap rates, continue to enhance our income return. And we call that our relative value perspective. Rather than going and buying super low cap rate multifamily industrial deals, we looked at off-market opportunities that would enhance our income return. That's what we're doing now as we raise capital as well. So continuing to emphasize that income return. 24 and 25 show some of what we've been able to do with the capital that we've raised this year. We focused on buying 100% leased investments, very core investments, longer lease term, good annual escalations, at inflation or above, and accretive year one yield. So that means accretive income returns relative to where the fund's income return sits. So we've been able to do that through 4 long-term lease industrial opportunities, 2 retail opportunities. We noticed that, again, there's not a lot of core competition. Most Odyssey funds are kind of strapped for liquidity with redemption queues. So we noticed a hole in the market for long-term lease industrial opportunities earlier this year. With that less competition, we're able to get some higher cap rate pricing that's been an enhancer for our fund's income return and newer builds, very core in nature. Same thing in the retail space. We got an HEB Anchorage Center in a wealthy pocket of Houston. We've been trying to get an HEB for quite some time. They don't trade very often. That's the prominent grocer in Houston, and also in Boca Raton. Our first investment in the retail space for our fund was in Boca Raton back in 2012. It's a Publix Anchorage Center. We really like the market. There's an opportunity to buy a newly developed center here, anchored by Whole Foods. Also has an REI, Lifetime Fitness, HomeSense, which is an offshoot of Home Goods. And these are both, at accretive cap rates, newly delivered deals. Longer lease term, very core investments, very safe investments that will enhance our income return going forward. And then on 26, wanted to briefly hit on our leverage strategy. We're a relatively low leverage fund, just like our competitors in Odyssey. We sit at 22% loan to value today. That's a comfortable spot for us. I think we'd probably like to be more in the 25% range long term, so we have the opportunity to take on some additional leverage with interest rates coming in a little bit more recently. There's quite a bit of lender interest that's made those spreads a little bit more attractive. I think we'll have the opportunity to secure some interesting financing going forward. The one thing I would point to is we've been able to keep our weighted average cost of debt quite a bit lower than our peers, which really benefits our income return. We did that by locking in kind of long-term fixed rate debt, meaning that interest rate was fixed for a certain period of time, 5, 7, 10 years, when rates were lower, 3 to 5 years ago. And so that 4.3% weighted average cost of debt is materially lower than most of our peers. So a pretty safe strategy, low leverage strategy. We don't really have any upcoming maturities that are an issue. We expect to be able to refinance those over the next couple of years. Of course, if we did need to pay them down, we have the liquidity on hand to do so. So that's where that liquidity position really helps us. How am I doing on time? We're getting pretty close. Should I turn it over for questions or keep going? Okay. Well, I can get through the portfolio a little bit, just give you kind of a high level picture of what we do own. Moving on to the industrial portfolio, you'll see it's pretty well diversified across the country. Over 5 years of lease term, very core in nature. But we like the diversification we have across all of these markets. Again, quite a bit of investments, and that's how we have that 40% weighting. Residential, same thing. It's we sit at over 90% occupied today. Of course, we would like to continue to increase that exposure, but well diversified across the country, and that's really our goal. I think we've evaluated other residential sectors like student housing, for example, possibly age restricted multifamily, but it's always going to require a very interesting opportunity for us to take a step outside of what we traditionally do, which is mainly invest in the main 4 property types that we know quite well. And then I've got brief summaries on the other sectors as well. The retail portfolio, which I mentioned earlier, is predominantly in the Southeast. That's mostly grocery anchored centers throughout the Southeast. Again, investing in those growth markets where people are moving to, we feel like is a very sound investment strategy. And then with our office portfolio, it's pretty limited in terms of what we do own. There's the life science investment in the Bay Area, but other than that, it's mostly in the Southeast, which is the Southeastern office markets have fared better than what we call our gateway markets, the New Yorks, the Chicago, San Franciscos of the world. So the office, even though we've been a low office fund really since the fund's inception, what we do own in the office sector has materially outperformed our peer set, which has helped from a return perspective. And then we've got some information on the fund at a high level, our key fund terms, but I think that really wraps it up. We can take any questions.
You had mentioned there's an entrance queue. Just kind of based on what you know today, if the funds were to make a commitment, what would be your anticipated timeline and kind of percentage of that money being called in?
Yeah, so we have again. So following our January capital call, that queue will get down to $113 million. So we have an idea of what January looks like. It's dependent on deal flow, but I think I will say we have other searches that are ongoing. But if you were to get into the queue today, I think there is a decent chance that some of that capital could be called in April. If not in April, it would likely be July. So I would say, really 1 to 2 quarters. We certainly not in January. We have that number locked in at this point, but either April or July.
And we often get asked about timing of capital flows, capital calls for clients coming into the fund. It's a common question now with challenges with liquidity coming back to investors like yourselves. And so we're happy to work with you guys to help you time, find the right time to come into the fund if you were to choose to invest in Smart Markets Fund. There's a couple of ways that we can think about that with you. One is that we can, prepare documents if you weren't able to commit all of your capital at one time. We could have the documents prepared and then wait until you had that commitment ready to fund, and we could sign the documents, put you in the queue at that point, and we can give you visibility around how long the queue is, and if the queue is getting longer, we can let you know. And the other option would be to do a phased commitment so that you could sign a commitment of a smaller amount than you were initially anticipating, and whatever you're ready to commit at this time, and then follow on with an additional commitment later when you're ready to fund that. So, and that's a simple 1-page addendum to your original subscription document. So, happy to help and work with you on that. Any other questions that we can help to answer? Well, we really appreciate your time today. We hope to win your business, and I just say, as you evaluate your options today, hopefully you remember the Smart Markets Fund is, we've had good long-term outperformance, good, stable, experienced team running the fund, and consistent outperformance. So we'll leave it at that. Thank you very much.
Thank you so much for your time.
Yeah.
Appreciate it.
Thank you.
Hit them to
Sure.
Thank you. Perfect. So we'll go ahead and just kind of turn the floor over to you, and please go ahead and jump right in.
Yeah, thanks so much for having us. 20 minutes or so? Is that okay? I'm Brian McDonald. I'm a member of the investor relations team at TA Realty. This is Jake Malil. He's the PM for our core fund. So really appreciate you having us down today. I'll give a quick intro to the firm, and then Jake can run through our core fund. Slides 7 and 8 are brief intros. So TA Realty, we've been around since 1982. All we do is private U.S. real estate investing. We're a partner-owned firm, super long tenured partnership. They average about 19 to 20 years together as partners at TA. Low turnover firm, really good really strong culture up in Boston. You can see here we're one of the largest buyers and sellers of industrial real estate in the U.S. We have been since our early days in the 80s, and we've expanded our team. So you can see here we have about 130 professionals across the U.S. Jake and I are in Boston. 90 or so of us are in Boston. We have asset management and acquisitions in Newport Beach, as well as Dallas, a small investor relations office in San Francisco. And then we recently launched our data center development team in Ashburn, Virginia, which is the largest data center market in the world. So you can see here 27 partners, 19 years together. And then just briefly on the platform here. So on page 9, so we're about 19 billion in assets under management today. Two kind of themes across the platform: super low leverage, low LTV firm, conservative debt profile, and low allocation to office, about 4% office across the entire 19 billion. We kind of have two staples of the firm today. We have Jake's core fund, about 8 billion in assets on the left side, and then we have our value add fund series. This has been since inception of the firm. It's been kind of the ballast of our firm when we're currently in market with Fund 14 in that fund series. So Jake, maybe Jake can intro himself and dig into the core fund.
All right. So good afternoon. Again, thanks for your time here today. As Brian mentioned, my name is Jake Malliol. I'm a partner at Tia Realty in Boston. Together with my other colleague, Sean Ruman, we're the two portfolio managers who lead this core fund. And we have since the beginning, which we launched it about 8 years ago. So Sean and I work together leading this fund, and we have since the inception. There's a lot of continuity there, which we think is really important for core open-ended funds. And we'll talk about that sort of the nuts and bolts of the fund here moving forward. Before we do, I think, core open-ended funds is really 5 things we think are really important you have to do. Not any one of those is more important than the other, but they're all important over time. Number 1, pick the right property types and the right markets. It sounds basic, but that you think are poised for tomorrow's growth, not yesterday's growth. And then 2 is then allocate your fund accordingly. That's the work of the acquisitions team. If you think, okay, Atlanta industrial, the Southeast, Southwest, whatever your strategy is, that's one thing, macro level, but then you got to go out and actually find the deals that fit that strategy. So that's the second thing. Third thing, and this is a big flaw in the core space, I will say, is you're typically buying stabilized assets, so things that are well leased already, and so it can breed some lackadaisical behavior among your asset management teams at these shops like us. You can't accept that. You got to have asset managers that are looking at these buildings saying, okay, even if they're 100% leased because they're core and stabilized, I got to go inside. I want to have regular meetings with my tenants, understand how their business is going. Industrial warehouse, are they growing? Are they contracting? Do they need more space? Whatever might be the case underneath the hood. So you have to have an engaged asset management team. You can't just collect the rents every quarter and say, okay, everything's going good because the rent came in. So really work in the cash flows aggressively, talking to your tenants. 4th thing, managing risks. Risks come in all shapes and sizes. This fund is now 8 years old, so we sort of lived through the pandemic period. We've lived after that, and obviously in the debt hiking cycle. Puts different pressures on your funds over time. So you have to manage those risks. That's the 4th thing. And the 5th is you have to sell assets before they become uncompetitive. That's a major flaw in this space because it's open-ended. People always just sort of think about growing for the sake of growing, forgetting that, like anything else, there's a couple assets, a couple things that we'd like to clean up over time or get rid of. And if you aren't prudent about that, you're left holding assets in a future market and trying to explain why they belong in your core fund. I talked about picking the right property types and markets. So it's kind of a joke, but I grew up in New Jersey. We're a big mall state in New Jersey. That's what New Jersey was known for. But if you still owned a lot of malls in New Jersey in these core funds today, you'd be really upset with your return profile. They might have done really well at a different time, but things have shifted. So you got to be able to continue to move these allocations over time to drive that outperformance. For us, that's the 5 things we think about all the time. And if you do those things, you can outperform your benchmark, which is it's called the Odyssey benchmark. The Odyssey is the benchmark of 25 funds who all submit their data, and it creates like an index, and you can kind of compare. When you compare our fund over this almost 8 years we've been active, or since inception, we're the number 1, 2, or 3 fund in the 3-year, 5-year, and 7-year, and since inception timeframes. because we're doing these individual things. It's like small ball baseball. You got to do all of those things to try to drive the outperformance. It's not one singular deal that's going to bring you home. So the fund itself, and I'm going to go to page 14 here, is an $8.5 billion fund today.
Can I grab you before we
Yes,
get too
please,
far away?
Daniel. Yeah.
So you have a dedicated digital group focused on data center
We do.
research or operations. Do you have assets in data centers?
We do as a firm. So let me be clear. We have a big data center initiative within the firm,
Okay.
outside of the fund, and within our fund, we have one investment that we just made this last quarter in Northern Virginia. So we could talk about it's a data center asset in Northern Virginia. I'm actually going there tomorrow. A bunch of our investors are coming to town to tour the asset with us tomorrow. So that we do have one data center investment.
Anything in energy?
Say it again.
Anything in energy?
Nothing in energy specifically. No.
Like nuclear plants? Or
No.
things like that?
No. Nothing like that. No.
All right. Thank you.
The energy it's electrical engineer. It's electric, and it's being driven by Dominion Energy, which is the major energy provider for the Northern Virginia submarket. So, yeah. $8.5 billion fund. This is on page 14. Leverage use of debt relatively low, 25.9, so just say 26%, which is to be expected in the core kind of execution. Occupancy 94%, so pretty well occupied portfolio, which is sort of a good health ratio to have a decent occupancy, good starting point. And a couple of things I'll point to is our capital flows. Entrance queue, we actually have a nice little entrance queue that's built up, so really proud about that. It's a sign of different investors across the U.S. and across the globe committing to the fund. So we have an entrance queue of $177 million today. If you go back over the last 4 quarters, we've raised about $700 million to the fund. So it's been really good acceptance in the broader investor community about the fund when they've looked at core, and we're really happy about that. The flip side of that is the redemption queue. We're at 0. And I think, again, that's an important thing. We cleared our queue. There's 282 investors in our fund, as you see in the below. Both Sean and I, as I mentioned, we launched this fund from the beginning. Every single one of those investors, we've come to meetings like this and talked to, right? And understood what their interests are, what the beneficiaries that they're trying to support are. And it's important that every single one of those investors, Sean and I have spent time with and helped onboard and sort of, have clients in the fund. The reason that's important is that when situations happen like we've had the last couple of years, debt hiking cycle is upon us, values come down, redemptions pile up across the space, so nobody was immune from that. One of the things we thought that, you can't escape the fact that we've come to these meetings, we've pitched this fund as an open-ended fund. It should be open not just for when the money's coming in, but when the money needs to go out. It's ultimately your investors' capital, not ours. And so what we said to ourselves at the time is our performance was strong in terms of like the returns, but we actually thought we'd been measured more on our ability to provide liquidity to our investors throughout that downturn. And so for that 2.5-year period, we never had a single quarter where we didn't pay any redemptions. We always paid some, like 10, 15, 20%, and we cleared our entire queue. We received roughly $1 billion in redemption requests. So it's not like we got nothing. We got $1 billion during that time. We paid it all out. And so I think this is part of that kind of day-to-day blocking and tackling of running a portfolio like this, open-end funds. It's not easy, but it's the sort of day-to-day decisions you make that you have to live with over long periods of time.
Jake, if I could stop just a quick second. You mentioned the entrance queue
Yes.
of 177 million.
Yeah.
Based on what you know today,
Yeah.
if they were to make a commitment, how long would you expect it to take to have that money called in, given the fact that there's an entrance queue?
Yeah, we are basically calling capital within 1 quarter of the commitment date. So for many investors, Brendan, it's I think folks have go through their own process to determine when they want to make these commitments, but then they don't want to be hanging out in queues for a long period of time. So we understand that having that capital called is also important. So we're operating on a 1 quarter basis, essentially, from the time the commitment gets made to when the capital will get called. Okay? Yep.
What's your for investments?
Our minimum is like $1 million. Yeah. So I'll just quickly touch on. I'll skip a page and just go to page 17, if you could. Middle. This is the first bullet that I talked about. You got to pick the right property types and markets. So the middle bar chart, property type diversification. This just shows how we stack up compared to the Odyssey Index. Remember, that's that benchmark of all the funds in this space. A couple things you'll see. starting from the bottom in dark blue, industrial, 43% for us, benchmark 34. So a nice little overweight to industrial. Light blue, multifamily, so apartment communities around the United States, 37% to 30. For us, we look at those two things roughly equal weight. So just call it 40, 40, 80% total in industrial multifamily. They might bounce around a little bit, 2 points here or there, but just take it in total, roughly 80% of those two. The Odyssey is about 65%. So a meaningful overweight to industrial multifamily property types that have had a really good run and we think will continue to have a good run on a go-forward basis. So we like that overweight. Another overweight that doesn't quite look readily apparent is in our, you'll see it in green, is our retail allocation. So it looks like it's exactly the same, 11% to 11% with the Odyssey. So it looks like the same. So why is it an overweight? The reason I'm saying it's an overweight is the only retail we have is grocery anchored retail. So it's a really kind of conservative retail. It's like the non-discretionary stuff that people kind of have to buy. And it's your top tier grocers in a market. Yeah, this question? Mm-hmm. It's apartment communities. Yeah, not single family houses. It's apartment communities. Yeah. No problem. So on the retail side, this would be your top tier grocery anchored centers. So if, Publix in Pompano or Pembroke Pines, sorry, we own that. It's the HEB in Austin. So if you go to these markets, you'll ask the local people, what do everybody shop at? It's that center. Everybody's different by market. Whole Foods in Boston, that kind of thing. We have a huge overweight. So the actual Odyssey index is only a little bit of that. Most of what's in the Odyssey index is like malls, back to the New Jersey malls. High street, these kind of expensive Hermes shops in New York City, that kind of stuff. All we have is grocery anchored retail. It's done really well for us. And so it's a huge overweight at that subsector level. Underweight position is office, and you'll see we're only 5% office. We have 4 office assets. The benchmark average is about 16. So when you think about where the overweights are and where your underweights are, we really like the relative positioning of our fund. On a go-forward basis, we think it should continue to sustain the returns. And then to the question that came up earlier about data centers, you'll see that in the kind of yellow up top, we have one asset in Northern Virginia. It's about 4% of our fund. The benchmark has about 9% in the other category. But most of that other is like self-storage and other things. Not really, data centers is like a small part of the overall Odyssey. I think, we're comfortable just with the one data center deal. We don't want to dial that thing up much further. These are kind of lumpy transactions. We like the investment, but we're not trying to double down on it. And then regionally, I'll just talk through on the chart on the right. Again, it's the property types and markets, right? And so when you look at the markets, the biggest distinction we have is our focus on your guys' region here in the South. So dark blue, 43% of our fund is in the South. And specifically, when we say the South, it's the population centers of Florida, Texas, I don't tell you, Atlanta, Nashville. That's the South. So that's what's kind of included in that 43%. The average for the benchmark is about 22%. So it's double allocation to an area that has obviously the fastest, population growth, GDP growth, corporate relocations, employment data. So we think we're positioned well, both in property types and markets. Underweight positions to kind of the lower growth areas, the Midwest and the Northeast. And so we think that that's really good on a relative basis. The last thing, I know we're getting close to time. I have a timer here. I don't want to hold you all up. I know we're the last one's up, so I'm respectful of the fact it's probably a long day. I'll just hit returns real quick, starting on page 19. So page 19 is simply, our fund's returns compared to the Odyssey Index across all the relevant timeframes since inception. So the top chart in dark blue is our net returns. Light blue is the Odyssey's net returns. And then below that in green is just the delta between those two. So the level of outperformance for each of those different timeframes. You'll see 1 year, 3 year, 5 year, 7 year. The numbers change over time, but the relative positioning does not, meaning we've outperformed the Odyssey across all of those different timeframes by different margins between 140 basis points over the last year and almost 400 basis points per year on a 7-year basis. So really good outperformance. Now, page 20, and this will be the last performance chart I'll show you, actually is a little more of a reflection of how we think. So page 20, same color scheme at play. Okay, so dark blue is us, light blue is the Odyssey. But this is what we think is actually the best measuring stick for open-end core funds. It's kind of rolling 3-year averages. So every quarter, you have a new set of rolling 3 years that you can look at your performance. The reason 3 years we think is important is in core open-end funds, things don't tend to change very quickly, but there can be some volatility quarter to quarter or on an annual basis. So when you take a step back and look at over 3 years, that's when you start to see sort of it smooths out any volatility either at the fund level or within your markets, and really says like over a longer period of time, 3 years, let's just say, it's the intersection of is the portfolio strategy being consistently supported in terms of the results of the fund, right? Not just one quarter or whatever. And so for us, the rolling 3 year is a really important chart. And our stated goal is to be top quartile compared to that Odyssey benchmark on all rolling 3 year timeframes. And what you see here, again, the same color scheme, dark blue is us, light blue is the Odyssey. The green is at the bottom, showing all the different levels of outperformance. But the more important thing is kind of buried in the middle, quartile ranking. We're top quartile compared to against every rolling 3 year increment since the fund's inception. And so for us, it's always trying to think about positioning the fund, doing those 5 things that I talked about at the beginning over and over and over so that every time we have a new 3 year bar, it'll show us at the top of the list. And that's been our goal. And fortunately, we've been able to achieve that. And our goal obviously would be to continue that moving forward. So maybe I'll stop talking and see if there's any questions.
Yeah, one question.
Yeah.
Back on 18,
Yeah.
it shows your relative weights.
Yeah.
They seem pretty stable since Q1 22. They've held pretty consistent. And you see that going forward. Is there anything are those going to change in any one direction?
Yeah, I would say relatively stable. The one thing that has been introduced is the data center deal at 4%. So that we think that'll stay around roughly 4%. Basically, big picture, I would expect our fund to have about 80% industrial multifamily, around 40-40, maybe it bounces 1 or 2 points on either side. 10 to 15% grocery anchored retail. So let's just say 10 to 12%, some of that range. The data center deal 4, and then office being a more and more shrinking part of our overall portfolio. So we don't expect office to be a big part of the fund on a go-forward basis.
So no major changes, but maybe as office shrinks, you guys will add more retail.
Yeah, exactly. Yeah, retail would come at the expense of more office in that case. Yeah,
Okay.
but I don't see us introducing a lot of new property types in the near term, to be honest with you. Yeah.
And pardon me for not paying attention. When was inception?
2018 first quarter.
Okay, thank you.
So coming up on 7.5 years at this point. Yeah.
Can you just highlight for us where the fee breakdown is or the terms for the fund?
Yeah, there's probably a fee page somewhere in here. It's page 55. But the short story is for the first 25, up to the first 25 million in commitments, it's a 100 basis point fee, and then it blends down as the commitment size tiers up. So, but it's 100 basis points for 25 and under. Thank you. No problem.
Any additional questions?
All right. We really appreciate the time today. Thank you. We'd love to work with you, but obviously you've got great candidates and great options on the board. So, all right.
Thank you.
Have a great Thanksgiving.
Thank you.
Thanks a lot. Thanks, Brendan. Okay, appreciate it. Thank you.
Everybody tired about real estate? Are you? The contrarian view?
Publix is well diversified.
Yeah.
To add to this, I met with a real estate REIT like right before this at 2:00, Cohen and Steers,
Mm-hmm.
and they're launching a non-listed real estate just like this, and it is exclusively focused on Publix and grocery anchored shopping centers. Like that's it. That's all their entire fund is.
Right.
That. So it does seem like a real popular space right now.
I mean, it certainly has done well, but it also comes back to the lack of diversification. You know, the typical buyer of that sort of fund is somebody who already has core, maybe even value add, and then they start, adding in more concentrated slices.
Yeah. I'm not suggesting we go back and introduce another option.
Right.
I'm just saying, like, I've heard a lot of things about retail.
Well, for the last 3-4 years, or going back a little ways, retail struggled a bit, especially with COVID. People not going to those stores. Industrial did very, very well in that run up as Amazon's and a lot of more e-commerce. That did really well. But are you going to get the same type of growth out of industrial for the next 5 years? Probably not. Not likely to get it out of office. So now you're looking at some of those other sectors, whether it be retail, because again, it hadn't done as well, but it's starting to see more signs of life, or the residential area. But that's what's so important about these portfolios. Unlike a stock portfolio, if you see a trend or you see something happening, within a day or two, you can reposition the portfolio. When you have $5 billion worth of, $100, $200 million properties, you can't just sell one day and buy one, another one the next day. So it's a big ship that you have to turn slowly. And that's why they really like to focus on when they're talking kind of what they looked like 3, 4, 5 years ago, to try to kind of give you a sense directionally what they're doing, where they're going.
Okay. Seems like a very tough market to navigate, because when you think about it in terms of groceries, it seems to me like the technology side of groceries is moving towards less brick and mortar, being able to buy through Amazon online, or people doing Instacart and that kind of thing, and having food delivered to their homes.
A lot of residential in the portfolios. A lot of residential. Residentials need groceries. So
right.
I feel like there's a lot more dice play in this arena versus the stock market. It feels like, I know the stock market can be volatile, but it always seems more stable at least in my eyes. You're going to get 10% on the annual basis in your stock market, where this is like, which way we go.
Just the data centers are concerning to me.
Yeah, but they're growing. They're popping up like crazy, and so are energy plants.
Yeah.
Mega. What do they call those? Mega.
Well, because you have to feed the data center. You
Right.
can't just have a data center with no energy,
Yeah.
Right.
and so you have to have some way to power them.
Yeah.
And they take a lot of power.
A lot of yeah.
Well, they're not a fad. They're not going away.
No,
So,
not going away.
Well, but I also liken it back to in the late '90s, when we were talking about the .com, which a lot of people refer to as a bubble, and the idea was, well, the internet's going to be kind of everything, right? So if it's got .com in the name, bid it up because this is the future. Well, a lot of those companies went out of business, and from a stock price perspective, they didn't do anything for 6, 7, 8 years in the early to mid 2000s. Yet everything we're doing is online. So it's sort of like the path was correct, but the horse changed. As you went through the process. So I don't doubt that AI is going to be transformative, and 10 and 15 years from now, a lot of things that are happening are going to be along that realm.
Yeah.
But the question is, is it NVIDIA on the stock side? Is it this data center? Or will there be other ways that it sort of manifests itself, as opposed to just what we
Some of these companies, the stocks have gone out of sight, and they haven't made a dime.
Right. Yep.
That's
But let me kind of bring it back to kind of where we are. So as a reminder, we have the JP Morgan Strategic Property Fund that we are in the process of redeeming from. As of September 30th, we had $4.9 million invested or still in that fund versus our target of $6.9 million. So on a current basis, we're $2 million underweight to real estate, and we're getting payments, albeit slowly, out of that JP Morgan fund. So if you don't do anything, that percentage will keep ticking down and will become more and more underweight to real estate. So that's kind of, again, why we wanted to begin this conversation, because it is somewhat of a slow process, and depending which ultimately fund you may or may not pick, there's a speed or a difference in terms of how quickly money gets invested. So I want to make sure we're kind of thinking about that and not getting too far away from target.
Are we supposed to make a decision on this today?
How do I say this?
Ideally.
You don't have to.
We should.
But remembering 3 months from now about presentation becomes very difficult, and oftentimes if plans wait, then it kind of gets fuzzy and it becomes more difficult to make a decision. But if you don't want to or are unwilling to today, you don't have to.
Well, maybe if we just do a quick show of hands, who liked which funds, we can eliminate one or open up a discussion.
Allowed to do that?
I think anything could be discussed, sure.
I like number 2.
Stockbridge,
And did anybody like number 1?
principal.
Principal. So nobody liked principal. That's cool. Who liked number 2? And number 3?
You didn't
I like them both.
at all.
No, I'm waiting to see how the room goes.
Yeah, same here.
They were
Same
very
here, 3.
they were very similar.
Yeah, and one of the reasons they're more similar is they're somewhat similar in age. They're a little bit on the younger side.
Yeah.
So if you were a fund that was in business 25, 30 years ago, there was a big part of that market where office was what was doing well. So in order to be competitive, you had to be in office. That had to be a big part of your portfolio. But when you're a younger fund, as a lot of that had played out, and then certainly by the time you get into COVID, it's easier to be underweight when you're kind of at a later starting point. So I just kind of want to mention that as a difference because again, the slow moving nature of these portfolios, the longer they've been around, the more you're going to have sort of a legacy impact from kind of prior versions of the market.
I was impressed by both of those funds, though. Just looking at Stockbridge, they were up near 25% in 2018, 2019, and they were able to get that down, to 10% by 22. So they moved pretty quickly, and I saw the same thing in the TA. When they realized the market was changing, they both were smaller, nimbler funds. They were able to unwind that office
Correct.
position,
which is certainly beneficial. And that was actually one of the catalysts relative to JP Morgan that kind of led to our recommendation to move. 4 years ago and 3 years ago, they had come out and said, we want to reduce office. This is how we want to change the portfolio. And 3 years later, it effectively hadn't moved. Where most of their peers were roughly saying the same thing, and you see all of them actually move, and that portfolio was staying relatively stagnant. So it was sort of a lack of execution. It's one thing to identify where you want to be, but if you don't actually go there, it doesn't help a whole lot. So
That's what I hear you saying, John, is you like Stockbridge.
I like Stockbridge just because they have that huge allocation to retail,
Right.
and it seems like that's where the puck is moving.
So is that your vote?
So it looks like it says Stockbridge has got $1 million minimum. TA's got $5 million minimum.
He did. That's the official stated minimum. But yeah, that, how do I say this? When, you know, we have to show sort of the official numbers, but when they come to a presentation, they can adjust that, and they will take a smaller amount. So again, the numbers today were essentially 2 million underweight. And one of the questions I was asking or making sure they covered had to do with the pacing of the queue. So what you heard from both Stockbridge and TA is there's no flexibility on the queue, on the entrance. So when you commit, when they call, whatever they call, you need to send them. Principal is a little bit different. They actually are very flexible. So you could commit $5 million and they'll maybe call it next month or next quarter. And you say, well, thank you. We see that you called 5. We're going to send you 1. And they'll pretty much just accept whatever you give them. And so you have the flexibility. Now, again, that's not the sole reason, but I wanted to make sure you understand that was different with Principal as compared to the other two and, quite frankly, all of their peers. Principal is really the only one that does that. So if we were to choose Stockbridge or TA, what I would suggest is we kind of do it in stages. So we're $2 million underweight. By the time paperwork gets done, you get to that point, what I would probably suggest is committing $2.5 million. Because that's likely about where the hole that we would be in by the time they actually call the money. Okay? If all of a sudden we see JP Morgan increase the pace of their redemptions, and all of a sudden we have an additional $2 million or $2.5 million deficit, then we just go back and add to the commitment. So effectively, we're going to do it in stages. Because again, if we just commit $7 million now, it'll get called in within 6 months. And if JP Morgan takes 2 more years to get us the other 5, then all of a sudden you've gone overweight to real estate. And we don't want to do that. So we have to be thoughtful about staging it in pieces to not kind of overshoot.
How do you feel about the 3?
Are
you allowed to opine on it?
Of course. I mean, first of all, we like all 3. I think Principal is a little bit more of kind of the traditional bellwether. It's going to look a lot more like the index, the average market.
They're the same as Principal Life.
Yeah, is the insurance company.
Life insurance.
Correct. I think Stockbridge and TA are both smaller. They're more nimble. They're likely to perform a little bit better. But again, because they're taking a bit larger sector bets, you also have a slightly increased chance of, if they get it wrong in office or retail, then having maybe a little bit more underperformance because they're not as diversified. But their track record has kind of proven they've been pretty good about those allocation decisions, and they've consistently outperformed. They're pretty standard. And page 11 of the core book that I have shows all 3 funds. So Stockbridge is at 95 basis points. TA is at 1%. So you're talking about 5 basis point difference between the two, with Stockbridge being the cheapest.
I'm sorry, guys. You're the chair, sir. You go. A question from the contribution queue when it has the first 2, Principal and then TA, have 1 to 2 quarters. Say Reliance says 2 quarters for Stockbridge. Is that guaranteed 2 quarters are in, or is it?
No. That's kind of just, and that's when I asked the question, I said, based on what you know today, what is it? Because just let me give you an example. What if all of a sudden they met with an investor tomorrow and said, we'd like to commit $2 billion? It's going to take a lot longer than a quarter to get that in. Or, if all of a sudden they have a large investor that wants to redeem, or all of a sudden they come across a new building opportunity, or a new building they want to buy. That's $300, $400, $500 million. Well, if all of a sudden, okay, now we have $200 or $300 million sitting in that queue, we can go ahead and put it to work because we got a building to buy. But if they don't have a building to buy, they don't want to just call your money and hold the cash. And so it's a little bit of a balancing act between what we see out in the market, what we have in terms of incoming investors, if there are any, and the timing.
Once we say, hey, we're picking the Stockbridge and we do the contribution queue, do we have to meet again to final it's good to go?
Correct.
Okay.
So I mean, essentially, if you were to vote well, no matter which way, so they say it's Stockbridge. Essentially, Pedro will go ahead and get the subscription documents or any contractual things worked out, and you're signing a commitment for a dollar amount. So then once that's in, then you're now officially in that queue, waiting for that capital call. They said, like I said, it's likely April and or June.
Gotcha.
But again, they can't tell you what the market's going to be in 4 or 5 months. And where everything, so they can't commit to what that is. But based on what they know today, they would expect to call your money in either April or part of it in April, and then the other part in say June.
$2.5 million you mentioned earlier, is that cash on hand redeemed from JP, or is that hedging that we are going to get that?
That is the amount we are underweight our target. So it is a combination of getting money back from JP Morgan, the fact that our equity portfolio and other portfolio is growing. So as the equity is going up and real estate, although going up, hasn't gone up nearly as much, it's shrinking as a piece of the pie. Plus we're taking or getting redemptions out of it, which is further drawing that down. So again, as of September 30th, we're $2 million underweight in real estate. I'm by the $2.5 million that I mentioned is essentially I'm adding a little bit to it because I figure by the time it's 3-4 months down the line, by the time the check actually gets sent on any commitment, we're going to get 1 or 2 more distributions from JP Morgan. I'm estimating, right? And then hopefully the rest of the portfolio continues. So I'm just guessing in 3-4 months we're about that $2 million gap is probably going to 2.5. And so that's why I kind of targeted that. But there's definitely an art to that.
So you're targeting using our target allocations, but if we only have. I'm looking at your thing.
Page 7.
Yeah, we have page 5. We have $1 million in cash right now. So we'd have to sell something to.
Yes, we would. Correct.
What's the significance of them not being an ERISA fiduciary? Does that mean they are not legally obligated to act in our best interest?
If Pedro on, I'd love for him to opine. But typically the way, and I'll jump in first but
he should be on.
They have to be a fiduciary to the fund as opposed to being a fiduciary to an investor. That's the difference. Because they have to treat everybody in the fund the same, their obligation is to the fund. They can't sign a different obligation to you. That's typically how I understand that working. So
I think that's exactly right. Can you guys hear me okay?
we can.
Yes.
Okay. I'm sorry. I'm just having a hard time hearing you guys. It's really the audio is very low. So yeah, I think just as Brendan explained that it's essentially they acknowledge that they're a fiduciary, but they are fiduciaries to the investment fund as a whole, right? Similar to your position, right? You guys are fiduciaries to the fund, not an individual member, so to speak. The same concept. They can acknowledge and they will acknowledge that they're fiduciaries to the fund itself, which generally means that our interests are aligned, right, as an investor in the fund. However, that's not always the case, and I'm sure we can all come up with different scenarios where there may be competing interests, although they're pretty limited. So that being said, all of the managers that you guys have interviewed or heard from today. We have agreements with them, and we have side letter agreements with them, and so they will acknowledge that they're a fiduciary. But to Dustin's point, they are a fiduciary to the fund, not to Jacksonville Beach general employees or Jacksonville Beach police officers or Jacksonville Beach firefighters retirement system specifically, or uniquely. Better way to put it.
Were they aware of our underweighted position when they came in here?
They know that you have JP Morgan and then you're in the redemption queue. We didn't talk specifically about the weighting or how underweight you were, but just essentially I wanted to make sure that they understood that, you know, part of the allocation that we intend to be in the space is somewhat tied up right now. And so I wanted you guys to hear from them, you know, the situation, you know, what it would look like in terms of commitments and timing and the like. Because it, you know, again, we're based on your current assets, you should be at $7 million. It'd be love to say, well, we just want to have $7 million with the fund we want to be in. But if you do that, then again, because of the restricted nature of the other side, then you find yourself in an overcommitted position.
I felt like principal like already knew that and the other two didn't, just based on the way they were acting. But maybe it's because they have that flexibility built in.
Yep. Are we open for a motion?
I make a motion to commit $2.5 million to the Stockbridge Smart Markets Fund with any unredeemed monies from JP to come from a rebalance in international equity. Too broad?
Second.
Hang on. Why don't we get a recommendation on a motion before we go too far? Either from you or from Pedro.
So the only thing I would throw out there would be to unlink those two things.
Okay.
You make the motion to hire them, or make the commitment and hire them.
Okay.
Yeah. And then second to that, let's have a discussion about, you know, if we want to do anything different in terms of raising the money for it or what have you. But I wouldn't necessarily directly link it.
Perfect. Then I amend my motion to commit $2.5 million to the Stockbridge Smart Markets Fund. Period. End of motion.
Does that work?
It does.
Is there a second from the police board?
Second.
No,
Oh,
let's
sorry.
do them board by board.
Second.
So I think you guys have to do it board by board.
We are.
Assuming you all are going to, you know, kind of engage the same manager, which you're obviously not required to, but just because each board has its own allocation, and so each of the three would need to make their own separate motions.
And I guess it is important to mention the $2.5 million is that's a collective investment.
Right.
So if there is one board that wanted to do something different, then we'd have to reopen that discussion, because again, that is all on a collective basis.
Or should the first motion just be to pick Stockbridge, period?
Well, the paperwork that Pedro would be assisting with is going to have to put a dollar amount on it. So I do think it's appropriate to pick that.
Do we have a dollar amount, Brendan, for each fund? Do you know, or do you want to just do like a percentage? You know, at the time of the capital call, or that way it's not a specific dollar figure, but however you want to do it. I
think what's easiest is to select a dollar amount, and then 6 months from now, as we see the JP Morgan situation continue to unfold, we'll come back with another recommendation, say, okay, we're ready to commit I'd recommend another $2 million commitment as an add-on. And just kind of do it we might have to do it in 3 or 4 smaller phases.
So what does the $2.5 million work? Is it even? Is it evenly distributed or split amongst the 3 boards?
Yeah, that's all done on an actuarial basis. We don't really cover that on the investment side. The three individual funds are pooled into that on a representative basis. So it's not like I say that the $2.5 million is, you know, 900,000 from fire and 1 million from general and so on. But again, to the extent that if one of the boards wanted to do something different, then that would.
I think what he's getting to, though, is for the purpose of this motion, does police need to say, can they just say 2.5 million collectively, or do they need to say a smaller?
Again,
Right.
I'll
That's
let
what
Pedro
I was asking.
opine on that, but we've always done it on a collective
Yes.
basis.
So
Okay.
let's just keep doing that.
Yes.
Okay, so we can. That's fine.
Okay. We have a motion and a second.
So I think if each board if each board just wants to go ahead and approve or make the motion to engage, and again, I don't know what it is, but if it's going to be the Stockbridge Smart Markets Fund, in the collective amount of $2.5 million as recommended by our consultant.
Perfect. We have that motion on the floor from the police board with a second. Madam Clerk, roll call for police.
David Cohill,
Yes.
John Patridge,
Yes.
John Godzilla,
Yes.
Jason Sharp.
Firefighters, if somebody wants to just say so moved,
So moved.
and a second, and any discussion? Roll call?
Second,
Yes, we did. Mr. Candler seconded.
George Candler,
Yes.
John Wiggins,
Yes.
John McDaniel.
Yes.
General employees?
So moved. Second.
We've motion and a second. Roll call?
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Motion carries. Moving on.
Now we'll jump into the 9:30, the actual quarterly review. I'm going to do my best to go through quickly because I know you've been here a long time. But this is our fiscal year end. This is kind of arguably the most important report of the year. So just really quickly, I'm going to open up to page number, interestingly, the page number is cut off, 4. We finished the fiscal year with a very strong quarter. I'm looking at the color bar charts on the right-hand side, upper right-hand corner. Should look like this. It's the thicker of the books that says period end September 30th.
What page?
Page number 4. They're on the left-hand side. It looks like, at least in my book, the printer cut it off. So I'm on this page 4.
Quarter performance.
All it says, it looks like page number 1, because it. I apologize. Apparently, we're having a toner issue or something. But again, I'm in the upper right-hand corner, and what you'll notice is everything was nicely to the right. Positive performance. S&P 500 was up over 8%. Small cap was up over 12.4%. So very strong headline numbers. If you look in the bottom right-hand corner, this is the 12 months that corresponds with the fiscal year. 17+% for the S&P. Almost 11% for the Russell 2000 small cap. International, roughly 16%, depending on the benchmark. And even fixed income was also positive. So that kind of what I call the major food groups, where we have the majority of our assets, were all nicely positive for the year. So as a general rule, we're going to have a pretty decent year. If you skip 2 more pages, it's going to be page number 7. I apologize. It's very difficult to see, but it's the one that looks like this. I tend to skip over this page, but there is something fairly telling. I'm focusing on the upper right-hand corner. What this page does is it shows you the 10 largest holdings within the Russell 2000, the small cap universe. I just mentioned for the quarter, the small cap benchmark was up 12.4%. If you look in that middle column, what you'll notice is each of the 10 largest companies within that index, the worst performer was up 13.8. The best was up over 253%. So it was very skewed. The performance was very skewed to some of the larger names, and all of them did significantly better than that sort of average or benchmark level return. One other thing that's kind of, it's not really in this particular set of numbers, but this last 6 months, and for small cap in particular, was the second worst period of active manager performance ever for the last 6 months, including this quarter for the Russell 2000. So if you take the all of the active managers over the last 6 months within small cap, it was the second worst relative performance that they've ever had in history. Very simply, the biggest factor that has driven performance was negative earnings. Companies that didn't make money did the best. Now, over long periods of time, companies that, in small cap, companies that make money outperform the ones that lose money by roughly 4 to 1. In the last 6 months, companies that didn't earn money outperformed the ones that made money by roughly 8 to 1. So you've had a very nuanced shift. And I partly the reason I'm bringing that up is we're going to get to our small and mid-cap manager, and their performance looks dreadful. But they're a quality manager. They look for earnings. And so they don't own companies that lose money. And so that part of the reason you're seeing some of that underperformance, and I wanted to just sort of highlight that just a little bit. So now let's go ahead and skip ahead to, it says page number 4, but it's page 14. It's the one with the big chart up and to the right, just showing our assets. I always like to make sure I'm touching on this particular graph. $138 million as of the end of September versus that net cash flow of almost negative $39.3 million now down there at the bottom. You can see the asset allocation. If you flip ahead a couple more pages to page 17, well, there's a lot of pages with the asset allocation. I like page 17 because it shows very quickly where we deviate from the target. You'll notice, I think this was brought up just a minute ago by David, we're about 1.6% overweight within international, fractionally under in domestic, and that 1.4% underweight to real estate. We've obviously taken some action to go ahead and rectify that with the new strategy. And then obviously we also have some cash as well. So with that, let's jump to page 21. How does this all come together? So for the quarter, we were up 3.6% in the 87th percentile, behind the policy of 5.39%. The policy was in the 22nd percentile. For the fiscal year to date, 9.58%, behind the policy of 11.48. So certainly disappointing relative performance. As we see, and if you move down the page, the bottom of that page, you can really see that the main culprit of that, Eaton Vance, negative 7.7 versus a positive 10.1. Huge performance deviation. Now, longer term, this strategy has been fantastic. They performed very, very well, but certainly have missed big within the last 12 months. And that accounts for a very large chunk of the total fund underperformance on that fiscal year-to-date basis. On the positive side, when we were sitting here, 2 quarters ago, we were in negative territory on the fiscal year. And so what I want to highlight from a positive perspective, if we were all sitting here in the middle of May talking about a -1%, -2%, I said, hey, I think we can get to positive 9.5 by the end of the fiscal year. I'm hoping everybody said, yeah, I'll take that. So ultimately, we did get that, finished with a very good ultimate fiscal year, but it did obviously disappoint on a relative basis. Just really quickly, since it came up a minute ago, page 22, we've had very nice performance out of international. International generally has performed a lot better these last 12 or 18 months. In addition to that, your selection of managers has also done very well. So international as a group outperformed by over 3%. You see on the fiscal year-to-date basis, 20.38 versus 17. With DFA, your new portfolio, up almost 26% over the last 12 months. Very good decision on selecting that one. And Euro-Pacific did about 15, and WCM was about 17%. But again, those numbers in total, or that international category, has grown more than domestic, and that's why we have that 1 point, I think it was 3% overweight now to international because of that relative performance. And then we've got obviously our fixed income. The fixed income actually did very nicely, 3.8 versus the benchmark of 2.5 with the multiple strategies blended together. And then PIMCO Diversified also did very nicely, 7.4 versus 1.5. So we had a lot of strong performance in particular outside the U.S. and fixed income. And JP Morgan, actually, even though we're in the redemption queue, that performance has turned around somewhat on a relative basis for the fiscal year, over 5% versus the benchmark of 3.8. But you see, obviously, when you get out to those longer periods, underperforming. And we've already taken some corrective action there. Let me pause. I know I ran through that very, very quickly. But are there any questions, comments, anything that I can answer for you? I do have one more book for you, but do you want to, typically you approve this by motion, do you want to go ahead and pause and do that first?
Can we go by board to have a motion to approve the investment consultant report of September 30th?
So moved.
Motion by please, and a second. Madam Clerk, roll call.
David Cohill,
Yes.
John Patrick,
Yes.
John Gottstella,
Yes.
Jason Sharp.
Firefighters?
So moved.
We have a motion and a second. Madam Clerk, roll call.
George Candler,
Yes.
John Wiggins,
Yes.
John McDaniel.
Yes.
General employees.
So moved.
Second.
We have motion and a second. Roll call.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Motion carries.
So the last book that you have in front of you, this was requested at the last quarterly meeting to get a little bit more information on private equity. So I put together this book. It does a couple of things. It kind of talks more broadly about private equity, some of the different characteristics about just the asset class, and then it also gets into a few examples or of types of strategies that are currently in the market. So I'll start on page number 3. And talk about some of the different parts of private equity. So on the left-hand column, you've got direct fund investments. So this is obviously where you're going direct, making a fund or an investment specifically with a particular private equity fund. But you typically need fairly large commitments in order to do those kind of direct investments. And these are one or kind of one-off basis. So generally, unless you're a billion-dollar plus system, you probably don't have the asset size where you're making commitments because you're not really getting a whole lot of diversification. Multi-manager and co-investments, again, similar. You got a fewer number of investments, but we are investing alongside a limited partner that's going in. Also from a kind of risk and return perspective, we'd expect the highest returns out of direct, slightly lower returns out of multi-manager co-investments. And so as you go left to right, you tend to get more diversification and a slightly lower expected return. Then third, we have fund of funds. So this is where you'll have a company, a manager, that actually is pooling investment dollars, and then they're going out and hiring, say, 10 to 15 actual private equity firms. So they decide, okay, we want to go partner with a healthcare private equity firm here, and now we want a finance and a technology. So you're partnering with a manager who then has a strategy, and then they make those underlying commitments. So it's actually a fund of funds. You tend to get broader exposure, a lot more diversification in your underlying investments, and that's a way to access proper level of diversification without quite the capital that you would need if you were doing it directly. And then on the far right-hand side is secondary investments. So this is a little bit different in that all the first three you are making kind of investments at the beginning of the life cycle of the investment. So secondaries, you're buying an interest that's already been around for 2, 3, 4, 5 years. And so you get a lower expected rate of return because the buyer of a secondary investment has already seen this company operating for the last however many years. It has a bit more of a track record, so it's more of a known quantity. But because it's more of a known quantity, there's less risk there. You also have a lower expected rate of return. If you move down to the next page, page number 4, one of the things that gets talked about a lot is the J curve. And this is what essentially investment losses upon making an initial investment into private equity. So the way private equity works, somewhat different from your other kind of conventional investments, is you are charged fees based on your commitment, not the money that you've actually given them. So I'll just pick a number out of thin air. Let's say you make a $10 million commitment to a fund, charges 100 basis points or 1%. So you're paying $100,000 a year in fees, but they may only, within the first 6 months, they're only going to call a smaller portion of that, maybe $200,000 or $300,000. So you've sent in $300,000, yet you've got $100,000 of fee coming out of it. So as a percentage, a $100,000 fee against a $300,000 investment is a pretty significant, percentage. So when you look at it on a percentage basis, in those first year or two, you'll see a negative number in terms of the return, a negative percentage. It might be negative 20, negative 30, negative 40%. Now, it's not negative 40% of the 10 million. It's only 40% or 30% on the 200 or 300,000 that you've sent them. but optically speaking, it can cause some kind of sticker shock, right? And so again, it's typical or important to understand that there's this J curve in the traditional investments. Now, the secondary market, because you're already buying seasoned investments, there tends to be no J curve. And what this graph kind of depicts is when you buy secondaries, they tend to go up right away and you don't actually go negative. But then over time, your overall return ends up being lower than the other ones because you get the higher growth from those other kind of more primary investments. Does all of that make sense? Okay. So again, I just wanted to provide a little bit of background and kind of the different parts of private equity and how it works. For the purposes of this, anytime I have a fund that does not have any private equity exposure and that might be considering it, what I usually do is start with kind of two different subsets. I start with secondaries, as I mentioned, because again, it sort of tends to mitigate the J curve, gets funds invested faster. But then I also show some different fund to funds, giving you a little bit more diversification. Now there can be a J curve impact, but as you will see, a number of these funds have begun to incorporate some investment strategies to mitigate the J curve. So even though the fund might be 80 or 90% traditional, what we call private equity, sometimes the first investment they make is to a private credit, or so they get some income right away. Or they'll do a little bit of secondaries, and they'll make a secondaries investment early to kind of create some yield or create income, so that when the other investments would be in the J curve, you've got some positive returns to help mitigate that. So with all of that said, on page number 7, just showing you the 4 funds that I'm showing you today. And again, what's important also, I should back up for a second. Within private equity, unlike the real estate funds that you just heard from, those are all open-ended. So if you wanted to get into principal or TA 2 years from now or 5 years from now, they're going to be around and available. In private equity, they're raising a specific amount of money over usually a fairly defined period of time. So they're going to try to raise $500 million and they're going to try to do it over 12 months. Right? So when they get to 500 million, they essentially stop fundraising. And so these funds won't be available a year from now. These are just ones that are in the market currently raising money. So if you're to say, yeah, we're interested in private equity, but we're going to wait 15 months to look at it, I'd have to come back with a new list because all of these funds will have been closed out and finished at that point in terms of fundraising. And would have to bring you a new list. So I wanted to just make sure you understood that kind of difference as well. But again, going back to that, we've got 50 South, Capital Advisors, High Vista, Mesero, and Taurus. Just so you know that 50 South and Mesero are secondaries managers. So again, I was trying to give you a little bit of a sort of a combination. And then the High Vista and Taurus are the more traditional fund of funds. Excuse me, I got that wrong. It was 50 South and High Vista fund of funds. Let me pause there. Would you like me to really dig into some of the different strategies? I know we've been here a long time. Part of this was sort of the education, getting a sense or a feel as to kind of what these looked like. We talked about the broader asset class. Would you like me to kind of go through the individual strategies, or what's the appetite of the boards, as we sit today?
Raise your hand if you'd like me to go through the strategies. Keep your hand down. I feel like we got a good little peek into the window of how we solve this.
Correct. Again, within sort of the ordinance limitation, even though it's private versus public, you'd still call it equity. So from the ordinance limitation standpoint, it would fall into the equity bucket. Correct.
I know you didn't get to give me the Super Reader's Digest answer on page 13, where 50 South is the preferred return is not applicable, and everybody else is at 8%.
good question. So typically in these private investments, the way they do it, so preferred return essentially is the first portion of the return that you get. So what this means is, the first 8% return of the fund goes to the investor. Then above that level, there's a carried interest, which means the portion of the earnings that they're going to share in. So a very common one is, say, 15%. So just to make the math nice and simple, if it was a 10% preferred return, so the first 10 goes to you. If they earn 20% in total, right? So that the second 10, between 10 and 20, if they get 15% of that, 1.5% of that total, or 1.5, would go to them. You get 8.5 of that next 10. So they begin to share in the profit, so to speak, above that preferred rate of return. So the preferred is that's the first portion of the return that goes to you, and then above that level, they begin to share. And so that's very common, but with 50 South, they don't have a preferred return, and because there's no carry. They just charge a flat fee, so there is no carried interest and obviously no preferred return. Good question. All right. Well, I will leave it there unless anyone else has other questions, but happy to revisit that, when appropriate.
Thank you so much for providing that information to us, Brendan. We have item F, which is possible action and kind of our placeholder. I don't think we have any additional rebalancing that needs to be done at this time. And okay. I'm like, how did we go from F to 2? Okay, 2, pension administrator report. Dustin.
Thank you, Mayor. Pedro, I'll start with a question for you. We have the summary plan descriptions coming up. The firefighters have identified a couple of changes that they would like to make in theirs. I know that we have a 2-year requirement on these summary plan descriptions to update every couple of years. So how do we handle this going forward? Should they approve this one and then we bring an edited one back at the next meeting, or should they not approve this one, or can they make recommendations to edit this one now? How does this work?
So excuse me, all of the above. So I mean, I think if there's changes that they want to make now and they know what they are, great. We can certainly discuss those, and the motion ultimately could be to approve the SPD as discussed and revised, and then obviously I'm happy to make those changes and get that back to you, or you can just hold off and wait till our next meeting. Again, the 2-year requirement, obviously, by statute, we do have to update these things 2 years, but the state has consistently allowed for some delays on that front. For example, if collective bargaining is going on and there's going to be a new contract coming forth, and we want to hold off, so as to not publish something that's almost immediately outdated, right? So depending on what the facts are, I'm not concerned about the 2-year requirement, to the day. So really, I think it's just up to the board in terms of kind of what it feels comfortable doing.
I would prefer to get with them after and get specific updates on what exactly we want to see in there and the changes in the wording, rather than trying to hash that out right now over what the exact details are. If we can just not vote on that one today and then bring another one at the February meeting. Is that?
Yeah, we've already found like 3 things that haven't been updated, and there might be more. So I couldn't tell you on everything.
Okay.
But what I didn't want to see is this looks. We would love to take this pension right here. It's listed on here, but if this goes, we're trying to get the same changes as the other boards. I just didn't want that published to show that we have a 2% COLA and stuff on there when we're we don't have that in there.
Right. Well,
those kind of things.
That's what I mean. The details of it. Some people do have a 2% COLA in there, but not all of the members. There are some finer details with that can definitely be added. So
yes, it has a 2% COLA, and then everybody after 2014, it should say 1% after that date and stuff. So it just has to be fixed.
Yep.
Justin, does it make sense just to hold on all three of them until we get there in case there's some consistent changes that need to be made?
That would be fine with me.
And if we're going to hold one, we may as well hold all three.
Yeah.
Right?
What's that?
Good. Like if we're going to do one, we may as well wait on all three.
That's fine with me.
Okay.
Give us some more time to review and go over these as well. Everyone, if they want to take a look at them. Okay. So we'll just.
And if anybody, if you want to just maybe, we can just talk offline. If anybody from the board, or if you want to just share the changes with me, and then I can make those changes. Happy to do that as well. However you want to do it.
Yep. Sounds good. All right. I'll dive into obviously quickly going to go through the pension administrator's report here. I just wanted to mention that those pension ordinance changes did go through. The city council approved the raises in the total annual dollar caps in 2025, 2026, 2027 to 110, 111, 112,000, and raising the drop rate from 3% to 3.5%. So that is now effective in our plans for the general and police. And then the general plan also added the language for service credit purchase. And so what's one of the things we have coming up here for the general plan to approve is the forms to make that possible. Pedro did recommend that we move forward with having the board actually approve some forms. So there's basically three forms. There's an application, and then a verification of the service, and then a form for how the employee wants the withholding done, whether that's in a lump sum or a payment out of their paycheck over a 5-year period. So since we're doing that for the general plan, we never actually went through that process with the police board, and these forms have been in use for several years now for police, so that is in here as well for us to officially approve those forms for future service credit purchases, just to make everything official. Continuing education, February 1st to the 4th, Rosen Center FDBTA winter meeting is there. I know got a new member here, so always recommend those as just a good educational thing. If you want to go, I wouldn't recommend starting the school in the first one. Just go to the first meeting and just try and learn and pop into whichever sessions seem interesting. And then, yep, like I said, new member. Congratulations to Mr. Wiggins for being elected. And we have 6 terms that are ending on March 31st, 3 on the police and 3 on the fire board. These are the 5th member positions and the 2 council appointed positions. So I will be bringing several things before council over the next few months to get those council elected positions. The 5th members are to be selected by the other 4 members and then approved by the city council as a ministerial act, which is actually what we have on the agenda today for the general board to approve. So, and then one other thing, we do have Brent Maresma sends his regrets that he could not be here at this meeting. This was scheduled to be his last meeting, and he has been on the board a very long time, since 2009. So definitely want to put that down as thanking him for his service to the board and its members and the community in general. So, any questions on any of that before we move on? We got a quarterly meeting. The next scheduled meeting for February 24th at 3 p.m. I did include the ordinance changes here in the book, if that's of any interest to anyone. And I guess on to the meeting calendar. Do we have any suggested changes or problems with the meeting calendar? Of our normal basically 4th Tuesday of each month that we normally schedule them in, with the exception of November, avoiding the Thanksgiving week and going to November 17th. All meetings starting at 3 o'clock, except for the May meeting starting at 2 o'clock, because that's the financial statements, budget, and actuarial report.
Can I have a motion to approve the meeting calendar?
So moved.
Is there a second? All in favor signify by saying aye.
Aye.
Any opposed? Meeting calendar is approved. Anything else?
I guess on to the general fifth members selection. All these three candidates have been interviewed by council. They have all shown their interest in their application for to be a pension trustee. Each one of them put pension trustee as their number one interest. I will leave that to you guys to go through the applications and make your selection.
Just to stay in order of the agenda, do you want us to do election of officers first?
I'm sorry about that. Yes.
So each of our boards needs to elect their chair, pro tem, and secretary. So be thinking about who's not here. General employees, does anyone like to make it? Let's just do them all three at the same time. Does anybody want to make a proposed slate? Chair, let's just do chair, pro tem, and secretary all together.
I'll take chair.
All right. Okay. Nick, pro tem.
Nick is pro tem.
Okay. Can someone just propose a motion for Dan Jansen, chair, Nick, pro tem, and Eddie as secretary? Or just say so moved?
So moved. Second.
Madam Clerk, roll call.
Dan Jansen,
Yes.
Christine Hoffman,
Yep.
Eddie Vergara.
Yes.
And for the fifth member, and don't worry, guys, on the absences that we have coming up, we had quite a few really good applicants. They're not necessarily all included on this, but in a recent round of interviews that we did for potential candidates. So I think we've got some good potential folks to fill in those holes. But in terms of replacing Brandon's position, did you have? I know you weren't in the interviews, but did you have a chance to look at them and have any thoughts?
Based on just these applications, I go Greg, David, Adam, but that's just based off what this piece of paper. So
Yeah.
I was going to nominate Adam Pedras.
I had Adam as a CRA.
Oh, did him? Okay.
Yeah, because that's what I had Molly bring in my.
Was pension his first or CRA?
He had pension and CRA. I put a star by it.
Okay. Yeah, that's fine. I withdraw.
And we can revisit with him maybe before any other open positions. But I had Greg Kleffner first.
Okay.
And that was your second.
That's my first.
That was Eddie's first and
My second.
your second. Okay.
Yeah.
Can someone nominate Greg Kleffner?
Motion to nominate Greg Kleffner as the fifth member of the board.
Second.
We have a motion and a second. Madam Clerk, roll call.
Yes.
Eddie Vergara,
Yes.
Christine Hoffman.
Yes. Okay, and then approve summary plan description for general employee. Oh, we're not going to do that. We're going to move that to a next meeting. And then the forms that were provided, do we need Pedro to go over those, or they were pretty self-explanatory?
Those were all provided by Pedro. They're very similar to the forms that were created for the police, just obviously edited for the differences. And I think they are pretty self-explanatory. I don't even know that there's really anything notable in here other than the verification of general service is for. So there's two ways you can qualify, whether you had your federal, state, or local service, or you had military service. For verification of military service, Pedro said that we could accept a DD-214. This is a practical thing because it's very difficult to get the military to respond to anything for verification and stuff like this. And DD-214 is pretty official. We know if it's less than 20 years, you're not getting a pension. And the employee also has to sign in these forms saying that they are not receiving a pension for that time. So other than that, I think it's pretty self-explanatory.
Okay. Can we have a motion to approve the forms as provided by Sugarman, Susskind, Braswell, and Herrera?
So moved.
Second.
Madam Clerk, roll call.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Thank you. Forms are approved by the General Employees Board. Please, who would you like your leadership to be?
Make a motion to chair Jason Sharp, myself, Chairman Pro Tem, and gentleman. Huh? Yeah, John, Secretary. You weren't here last time when I nominated you, so.
John
I get to look at you
Godzilla?
This time when I throw you under the bus.
John
So the
Godzilla?
same lineup, yes.
Okay. So we have a motion for Sharp Chair, Cohill Pro Tem, and Gostilla Secretary.
So moved.
I think he was making the motion, so you're making second?
Second.
Madam Clerk, roll call.
David Cohill,
Yes.
John Patrick,
Yes.
John Godzilla,
Yes.
Jason Sharp.
Yes.
Thank you for your service. And you also have the forms for purchase of prior service credit, et cetera. Can we have a motion to approve?
So moved. Second.
We have a motion and a second. Madam Clerk, roll call.
David Cohill,
Yes.
John Patrick,
Yes.
John Godzilla,
Yes.
Jason Sharp.
Thank you. And moving on, firefighter board, same question, Chair, Pro Tem, and Secretary.
I make a motion to make Mr. Candler the chairperson, myself pro tem, and Lance Hewish as the secretary.
So moved.
Can we say yours was a motion and his a second?
Second, yes.
Okay, perfect. Madam Clerk, roll call.
George Cameron,
Yes.
John Wigan,
Yes.
John McDaniel.
Yes.
Thank you also for your service, and we will do all three summary plan descriptions at a future meeting. Any other items for discussion? Any other courtesy of the floor? This meeting is adjourned.
Yay. Good meeting. Good meeting.
All right, everybody, have a good Thanksgiving. Have a good holiday.
Stuck them in the car.